Ladies and gentlemen, I call myself a long-term stockholder. And in fact, there are positions in my portfolio that I'm still holding for over 7 years now. But whenever it comes to SoFi, I feel like the conversation shifts and that people want to talk about quarter over quarter results without actually talking about the success of the business over a longer period of time. Well, I want to debunk that. So today, I'm looking at a 4-year review from the earliest public information that we have on the company from Q2 of 2020 to the most recent quarter that came out recently, Q2 of 2024. Let's just jump into it, okay? Members have grown 630%, while products have actually grown faster than that at 680%, going from 1.6 million to 12.7 million in just a 4-year time frame, okay? Products per member has increased during that time, and the amount of new products that have come onto the platform have been majority actually financial services products, which you'll see here. Lending has actually gone up roughly about 107% over this period, where financial services has gone from 783,000 to nearly 11 million, or roughly about a 14x during this period. Just an insane amount of growth, right? The technology platform, which everyone's talking a lot right now about the slow growth quarter over quarter, but whenever you actually zoom out, we've gone from 36 million users to 158 million technology accounts that SoFi services. Okay. On a per product basis, we got personal loans going up 160% or up to 1.2 million. Home loans have gone up 200%. Student loans, which got completely taken away from us, had still gone up 40%. Then on the financial services side, money has gone up, or their checking and savings accounts products has gone up 1,850% plus. The invest product has gone up 600%. Credit cards are a new product, but they've added 260,000 new credit cards. Referred loans, also a new product, that's gone up. SoFi Insights, which is their financial, sort of budgeting tool, which has gone up nearly 1,600+%. And SoFi at Work has also increased over 1,300% as well. On the financials, what we can see is just as stellar. Net revenue has gone from 115 million to 600 million a quarter. Now, whenever you look at revenue per member, it looks like it's climbing all the way down to less than $60 per member. But we have to remember that lending has gone from, revenue per lending product 111 to $190 per lending product, and financial services has gone from $3 to $16. So even on a per product basis, there's been no slowdown. It's just a matter of the shift from the very high revenue of lending and going more into financial services. But that doesn't mean that lending isn't growing also. It's skyrocketing, 95 million to 340 million. Anyway, on technology platform, similar story. 20 million up to 95 million, increase of 400%, okay? And revenue per technology account has also increased, all right? Corporate revenue has actually climbed up in further negatives because the company has become much, much larger. But then even on profitability for each one of these segments, we can see that lending has gone from 50 million to nearly 200 million, and the margin has improved. The financial services used to be negative, now positive. The margin has, I don't need to speak for it. I mean, negative 1,200 to positive 31%, insane, okay? And then contribution profit for technology platform, 63% has actually dropped down to 32% as they've scaled the business quite a lot. Got a lot of much larger customers that don't take as much, slack in terms of the margin that they will take on. Overall, total contribution margin has gone from 26% to 46%. Net income, this is actually the only quarter, if you were to look even further out on both sides, it's all red. It's all negatives up until the 3 most recent quarters, okay? This just happens to be the one quarter where they actually do look slightly positive. Here, once again, they are bringing in more money, 17 million, but at a lower margin comparatively to this one standout quarter. All right. They became a public company, so that shows off the outstanding shares. They weren't a public company back then, so there was no dilution. Stock-based compensation is much higher now, but stock-based compensation as a percentage of revenue has only gone from 20% all the way down to 10%. Really good signs. And then adjusted EBITDA has gone from negative 23.7 million at a adjusted EBITDA margin of negative 20% to a positive adjusted EBITDA margin of 23% or $138 million. Ladies and gentlemen, this is a fuller review of SoFi's earnings. If you plan on being a long-term shareholder, try to project out to where you think this company will be over the next 4 years, over the next 8 or even 12 years, right? Stop worrying about every individual quarter and how you might sell if we get another downgrade down to $4 a share. Focus on the long term. Thank you for watching, and bye for now.